Look, I think there's a handful of mistakes that are a function of people trying to do deals when they shouldn't. We didn't do any deals between 2022 and 2024 except for a single 1031 exchange. And that was only because we needed and wanted to get out of an asset that had gone up so much that we felt like we were compelled to sell it. Um, so I think it's the sort of desire to do deals when you should just sit on your hands. I think it's also how you finance a deal. I think back in 22 and 23, a lot of people were using floating rate debt. They were using very high leverage. And those two things will blow up a deal.
Welcome to the Real Estate Pros Show, where we interview real estate investing professionals from coast to coast, as well as the service providers that serve the real estate investing industry. Our goal is simple: share what's working now to help you improve and scale your business to the next level and meet the pros that can help you get there. Real Estate Pros is powered by Investor Fuel, America's leader in helping real estate investors and professionals build the business you need to live the life you've always dreamed of. Let's start today's show. Property insurance for real estate investors doesn't have to be difficult, but it does need to be there to protect you when you need it. MyInvestorInsurance.com not only provides insurance at 15 to 30% cheaper than traditional agencies, it's built specifically for real estate investors like you. You can set up an account in about 2 minutes, get quotes on properties, turn on and turn off insurance for your fix and flip or rental properties in around 2 minutes without having to talk to anyone directly, all through our portal. There's no better way or faster way to make sure you've got the coverage you need to protect you, and no more lengthy policies either. Once you're set up, you're billed monthly and prorated by the day for however long your policy is active. It's powered by MSI, the third largest independent MGA, with 1.5 million customers and more than $1 billion in cumulative premiums written. Get set up today in about 2 minutes at myinvestorinsurance.com/fuel.
Hey folks, welcome back to the show. Today's guest, Kyle Theodore, out of beautiful Newport Beach, California, is the head of capital at Vanamor Investments, a multifamily value-add investment firm, and also spearheads the equity formation process for the firm's portfolio. He has over 25 years of experience in the institutional investment space, and he's a graduate of Claremont McKenna College, holds an MBA from Yale, and is a CFA charter holder. You can find him at vanamor.com or on LinkedIn. Kyle, thank you for taking the time today.
Of course, happy to be here. Thanks for having me on.
Now, when we talk specifically about capital raising and deploying capital into real estate, this has been a challenging 5 or 6 years to be in this space. I've talked with many folks who many have done well, but some have struggled. And as someone who's active in the space, and we were talking a little bit about this before hopping on here, I'd like to start by asking, for folks who are raising capital and who are deploying other people's money, what do you think is the biggest mistakes that some people are making now and then also maybe over the last couple of years?
Look, I think there's a handful of mistakes that are a function of people trying to do deals when they shouldn't. We didn't do any deals between 2022 and 2024 except for a single 1031 exchange. And that was only because we needed and wanted to get out of an asset that had gone up so much that we felt like we were compelled to sell it. Um, so I think it's the sort of desire to do deals when you should just sit on your hands. I think it's also how you finance a deal. I think back in 22 and 23, a lot of people were using floating rate debt. They were using very high leverage. And those two things will blow up a deal. We never use floating rate debt. So all of our debt typically has the same duration or longer duration than our expected hold. So if we have a 5-year hold, we have 5 or 7-year paper, and it's all fixed rate. We're also a low leverage player. We're typically 60 to 65% LTC, but the deals that I saw getting done in 22 and 23 were at 80, 85% leverage, and they were using floating rate debt. And that's a recipe for disaster.
Now, from the outside looking in, and I'm just using my perspective as someone in the single family space, right? So if I'm, working with buyers and they're asking me, hey, we're looking at an adjustable rate mortgage, or maybe we'll pay more for a fixed rate, I'm kind of inclined to say, well, you can't see into the future, so it may cost you more right now for the fixed rate, but over the long term.
Stop living on an island and join the #1 mastermind in America for professional real estate investors. Investor Fuel is a community of hundreds of the nation's top investors working together to build stronger businesses and better lives. In addition to the amazing community of real estate investors acting as a board of advisors for one another, Investor Fuel members have access to 100% funding on purchase and repairs for our members only, a health insurance program, and benefits and discounts that more than pays for the membership of most of our members, meaning it's actually costing you money to not be a member of Investor Fuel. If you're looking to scale your business and build a business that allows you to live the life of your dreams, please visit investorfuel.com today and book a call with our team.
You'll have more stability. At least you'll know what the rate is going to be. It's not going to double. I feel like that same type of logic applies it to multifamily investing. At
100%.
least it should.
100%. And I think it's people get greedy and stretch to do deals when they shouldn't. And if it doesn't pencil with fixed rate debt, you shouldn't do it. My home in Newport is financed on a 30-year fixed rate mortgage at 2.75%. Right. I wish I'd taken more money out when I refied it, because I'm sitting on a lot of equity in the home. But that is, that's, the two things you can control are, you know, what you're paying for insurance and what you're paying for debt. Those are the two big variables on financing a deal. And if you can't get it to finance on fixed rate debt with the same term as your expected hold, you shouldn't do the deal.
Now, when we talk about value add, a lot of times people may think about, well, there might be some level of physical distress in the property, but I've seen more and more that there could be like operational distress. Do you have a preference for one or the other, or do you need maybe a little bit of both in order to have a successful project happen?
Typically, we are a kind of light value add operator. So our price per door on average is 10 to 15,000. We're mostly doing, flooring and cabinets and countertops and putting in stainless steel appliances, putting in new lighting, maybe resurfacing the outside of the building, putting new paint on it, maybe adding an amenity like a barbecue area or a gym or something. We're now in California doing some ADU conversions
Yeah.
where we can take a place that's overparked and add additional apartments to the existing door count. But we're not typically kind of heavy value add. We're buying fully occupied buildings, so our typical occupancy at purchase is somewhere between 90 and 95%. So we're typically not a like science experiment. We don't empty the building and then renovate the whole thing and then try to re-tenant it. We're just doing value add as we get unit turnover and then commanding higher rents on that kind of refresh. We're typically 2090s and newer, 2000s and newer. So 20, 25-year-old buildings that just need a bit of love to kind of look modern. We like to stay 90s and newer because we want 9-foot ceilings. You can't make a low ceiling high. And typically a 90s and newer will have 9-foot ceilings, and those show better versus new product. So you typically will command better rents than you will on the kind of 70s and 80s stuff.
Now, for dealing with property management and the existing property management, I've heard from people who buy multifamily properties that in some cases you might have a property manager that may not be overseeing the property correctly, but that in order to bring in a new property manager, that's going to be potentially challenging as well. So sometimes you have to decide, well, is this property manager, maybe so mishandling the property that we have to bring in somebody new, or can we maybe keep them in there but monitor the process, basically manage the property manager? What's your perspective on that?
I guess a couple things on property management. One, we use third-party property management for all of our properties as opposed to doing any self-managing. I think that's important from an LP and investor's perspective in that we're on the same side of the table as they are. We're trying to negotiate the lowest possible property management costs. When you have a dedicated property manager, and I won't say we won't ever do that, but at some point, you're not going to fire yourself, right? And it's another layer of fees that LPs are paying.
If you're looking for consistent, high-quality leads, look no further than Investor Machine. Investor Machine isn't just another agency, it's the most sophisticated, data-driven lead generation company on the planet for real estate investors, and serves the role of being not just a lead generator for your business, but a marketing partner that is helping you achieve your goals along the way. Go to investormachine.com to learn more and schedule a call with our team today.
Now, we still have some incentive to keep a dedicated property management fee low because we want to hit our pref, but I feel like that has better alignment of interest. For me, it's more about who the individual person is. We typically use FPI. They're a big, very large national company. We're not wedded to them. So if there's a market where we think we can get a local property management company that'll do a better job, we'll use them. But we're 100% actively involved in the hiring process of the local people. So when we take over a property with FPI, we interview the leasing agent and the maintenance person personally. We do weekly calls for every single one of our properties to kind of talk through vacancies, any repair orders, kind of upgrades that we need to do. So I think being really engaged and having a third party property manager, at least for our model, is what works. Doesn't mean it's always perfect, but we have enough leverage with FBI that if we've got someone who's not performing at a particular unit, we can get them swapped out. I think, but at the end of the day, the tenant doesn't know that they have the FBI. They know they have, Don, the maintenance guy, and Sue, the leasing agent, right? So those people matter a lot. And I think being part of that interview process is important.
Yeah, I mean, I've spoken with multifamily operators who've told me, they've changed property managers only to realize during that change, it caused so much turbulence that they might have as well just kept the maybe underperforming property manager in there and tweaked some things. So, not necessarily always just changing can be a solution. It might cause some more issues.
No, it's an expensive thing to do, and it creates friction. And so you're much better off trying to replace the individual person that's underperforming than the property manager, unless you're having a kind of persistent problem with getting the attention of whoever the property manager is.
I want to pivot a bit here and ask you about the multifamily space in California in general. I know you're based in California. You're investing in a number of different states: Utah, Nevada, Texas, Arizona, Florida. But in California specifically, is there still a trend where you're still seeing a lot of new multifamily housing going up? I know a lot of new construction isn't necessarily penciling, but are you still seeing a lot of new multifamily construction ground up?
Not a ton. And to be fair, we only really operate in Orange County, Riverside County, and San Diego County. There are a lot of, I mean, I just got off the call with a large investor that is pencils down on California. He just doesn't want to own in the state. And I get that sort of feeling, right? Because obviously the politics here aren't great, and tenant landlord laws favor the tenant in most cases. Those counties are pretty conservative, and tend to have better kind of relationship, tenant landlord laws. We find because there are a lot of people with pencils down, there's real opportunity in California, but you have to be very selective. Like we'd never be in Santa Monica, we'd never be in San Francisco, there, LA County in general. And so I think it's important to know where you're investing from a micro market perspective. And I think there's opportunity. I think from a new construction perspective, there's some urban infill, there's some stuff maybe that's getting done. There's not a lot of new development in California because, as you suggest, it just doesn't pencil. The current property that we're under contract, we're buying at 40% below replacement and 10% below the last appraisal. So why would you ever build a new one?
Yeah, and that's part of the challenge, I think, because people are trying to, address this housing crisis, right? Which I think a lot of people, especially young people, feel. But then you also have to realize that, there's investors involved in these deals. And when there's, COVID moratoriums on rent, I guess it depends who you ask. Some people said we did great during COVID because people were basically getting the money from the government and we were guaranteed to get paid. Other people said, we didn't get paid, and other people said we had no issue. But when you have disturbances and turbulence like that, and then you also have more people building in markets like Texas, specifically where I'm licensed.
If you're a new or newer real estate investor looking to launch or grow your real estate investing business, please check out Investor Fuel Club. It's a coaching community, but unlike anything you've ever seen before. And you can actually partner with members of our mastermind from coast to coast on deals right in your market. There's no better opportunity to build a consistent business than to literally partner with pros to help you avoid costly mistakes, avoid the need for capital to do deals, and help you eliminate your fears as you're starting your business. Learn more about Investor Fuel Club at investorfuel.com/club.
It can have a very really disastrous impact on multifamily investors at large, because remember, when with these projects you're starting, and then it could be 18 months, 2 years, maybe even 3 years before it's 100% finished. So in that time you're looking at a totally different set of market conditions.
Yeah, and that's why we typically don't do any ground up. We buy existing structures that are fully tenanted, so we know what the economics are. Development can be very profitable if it works and if your delivery coincides with kind of a demand surge. But you look at some of the projects that went on in Austin, right,
Yeah.
during that
Yeah.
huge boom. They thought it was a great market until they started delivering into a real glut, and they couldn't command the rents. People, at the height, I think they were giving 3-month rent concessions just to
Yeah.
get people into the projects. And you can't, if you give a quarter of your annual revenue away, it's very hard to make money.
I mean, I don't want to say it's going on still to that degree, but I have multiple contacts who are telling me that there's places that are heavily incentivizing right now, not just in Austin, but really all across Texas. And it's interesting because when I was living there, this didn't feel like that long ago, maybe 4 or 5 years ago, that was not the case. You were still having to pay like first, last, finder's fee. I was like paying all these different things. I said, gosh, I hope this is going to good use. But now it's almost like they're paying you in some cases to move, and it certainly feels that way. I would like to ask you specifically about the tenants themselves. I mean, when you're purchasing these properties, they're going to be occupied. You mentioned like 90% occupancy. Uh, are you also able to see like delinquencies, what percentage of the tenants are paying and on time? And then also too, do the operators themselves, I know they don't always do the operators themselves always have good books that you can rely on for that type of thing?
Yeah, I would say in general, the data is pretty good. Before we buy any property, we always look at rent rolls and ask for current rent rolls. We also do a drill down into kind of AGI and sort of what the tenants are making, right? The ability to kind of essentially pay their rent. The project we're working on right now, which is Riverside County, I think it's $155,000 average AGI, which I don't know how they're making 155,000 out in Riverside, but it supports pretty high rents, and that's important to us. So we always look at that, and I think that's really important. It's part of the due diligence that's on the kind of tenant side as opposed to the building side. But you also want to look at roofs and HVAC and any deferred maintenance, right? It's part of what you have to do as an operator to ensure that you're not buying a science project, and we don't do science projects.
Now, I've heard this term workforce housing, or like renters by necessity. And I've heard it mean a couple different things. When I hear it, I think like, well, people who maybe would like to buy, but have been, shut out of the buying market, and now they're renting. Under those conditions, it almost seems like, hey, we can increase rents every year because these people need a place to stay. And but they would like to be here. We have a upscale or luxury housing for them. Do you find that wherever you are in the country that you can continue to raise rents, whatever it is, 5% a year, and that will always pan out?
No, I think having an expectation of sort of always higher rents is in today's market is challenging. I think what we're trying to do is buy stuff that's just outside of workforce housing, so slightly higher sort of tenant quality, and one where we can pass modest rent increases, 2%, 3%, and still have the project pencil. So, a lot of the markets are actually seeing falling rents
Yep.
because of the supply, and Arizona and Texas are sort of the poster childs for that,
Yeah.
because there's still just a lot of supply. What's interesting though is we're starting to really look in those Sunbelt markets. We're trying to do deals there. So far, we haven't found one that's penciled for us, but we think that market's starting to turn. If you look at new construction, it's off 90% in those markets. And so eventually that product will get absorbed and it'll be a good time to be an owner. I think we're probably 12 months away, maybe 18 months away from that being the case. And so we'd like to be there, because nobody's building new projects at the moment.
Yeah, I mean, they're not penciling, right? And because of that, you're also seeing some, I would say, alternative projects going on, not just in multifamily, but I'm talking to investors in Los Angeles and right in California, right, who are building lots of ADUs. There seems to be lots of ADUs happening, I guess, everywhere in California, specifically in Los Angeles. I don't know how much institutional guys like yourself are looking at ADUs because these might be in someone's backyard. But in general, do you feel like there's an energy surrounding ADUs in California? Is the common man and woman looking at, hey, maybe I'm going to put an ADU in my backyard?
Yeah, there's another operator that I'm pretty close to, where I know his construction guy. They've, I think, got 230 ADUs. They've worked through about 80 of them. He's still got 150 to do. And it's existing projects that they own where they're overparked or there's the opportunity to add additional tuck under apartments in the garage space. We actually, our other Riverside project, we are doing ADUs. It was heavily overparked. I think 1.9 parking spots per unit. And so we're going to do ADUs in some of the garages. There's 100 garages. And so that's a good add-on. Our current project, we've got some office space on the second floor that we're going to convert to ADUs. So it's not typically the driver of return, but it's a nice extra lift on a project if you can do some ADUs. California is unique in that both ADUs and solar pencil. So we've also been doing solar for the common areas to kind of reduce the running expenses of the property. That's another way to kind of generate more revenue by just lowering your expenses.
I mean, the office to ADU conversion, that's an interesting one. I'd like to learn more about that. I guess there's a lot of ADU development conversion happening in general in California. We
For
are
sure.
coming up on time here, though, Kyle. Any new projects that you're working on? And then also, what's the best way for folks to get in contact with your team?
Sure. So we're currently raising for a project that's out in Riverside. It's a two building project. We're buying it directly from the developer. Developer has operated it less well than he developed it. And so we think there's some operational lift we can get. As I mentioned, we're going to do some ADU conversions on some second floor office space. He's got so there's two units. It's two buildings. One's 89 doors, the other's 36 doors. The larger one has a rental apartment that's available to tenants to rent, gets rented like 3 or 4 times a month. We're going to just turn that into another unit. So we'll get, a full-time tenant in there. So the little things like that, where you can sort of get an operational lift and operate it, better than the developer did, is how we get to kind of the numbers that we're trying to get to. This one I think is a in place cap rate of 6.3. We're buying it 40% below what it would cost to actually build it today, 10% below the last appraisal. We're seeking to get a 15.5% IRR over a 5-year hold. So it's a pretty attractive deal. Some people don't want to be in California, but if you want to be in California, I haven't seen a 6+ cap rate in a while. So it's a pretty juicy deal. It's a $40 million purchase price. We're raising $15 million in equity. We've got about 3 left. If anybody's interested in kind of learning more, they can go to vanamor.com, which is our website. My personal email is K Theodore, so K and then Theodore at Vanamor.com. Feel free to send me an email. I can get you kind of linked to our portal. That would not only sort of let you know about this specific deal, but future deals that we have, and would love to talk to any active real estate investors that are interested.
Kyle, thank you so much for coming on the show. Thanks for your time today.
Yeah, really nice to meet you. Thanks for the time.
Thanks for joining us for today's Real Estate Pros Show. You can learn more about the amazing benefits of the Investor Fuel Mastermind community, including surrounding yourself with hundreds of other rock stars, 100% financing for your deals, and members-only discounts from vendors you're likely already using that, as a member of Investor Fuel, will save you more than the cost of your membership. Visit investorfuel.com to learn more. If you're interested in joining us as a guest of this show, please visit investorfuel.com/pros to apply. You can also check the show notes for access to free resources, how to get access to world-class lead generation, and much more. Don't forget to subscribe so you never miss another episode. Have a great day. We'll see you on the next show.